Hello guys, I'm Mariano, the trading parrot. Since the bearish news yesterday about the tariffs, the general markets had a little retracement, causing again new sources of fears, and as a result of that, the 4-hour and the daily time frame are currently testing support. In this video, we're gonna look into what are those levels and what could happen if we lose those levels, potential targets to the downside. I am also prepared for the bulls to defend those levels, and we can see what could happen, particularly because we are in the middle of the weekend, but with an eye on how I'm expecting markets to react next week if the fears went away as well. Let's face it, we are in February, and according to seasonality, we tend to have a pretty good month. In today's video, I'm also going to have a monthly candle close special. This is gonna be a section of the video where I focus mainly on long-term holders, people that want to ride the full bull market holding Bitcoin. We're gonna look at the RSI being above 70. For how long should we be expecting that? We're gonna look at the CPR model to see what we should be expecting for February once again. Guys, if you like this type of content, make sure that you are subscribed to the Coin Bureau Trading. Dan, Aaron, and myself, we are putting videos and making sure you have daily content when it comes to trading, not just setups, but also very good tutorials. And if you want to stay on top of the price, I publish up to 4 updates a day in my channel when it comes to Bitcoin and altcoins. My last video on Friday was this one, something big is cooking. We spot a huge confluence around 102K when we were recording the video at 106 and beyond. That did play out. Make sure you have a look at my channel as well. So yeah, apparently Trump is very stubborn with going with the tariffs starting from today, applying to Canada, Mexico, and China. And this had an immediate effect in the price, not just of Bitcoin, but general markets. On Friday as well, the last day of the month, the options were expiring. We are talking about 8.4 billion in options with a max pain level at 98K. Of course, this is just finished, and people think once we get over the options, we should ignore them. But notice that in beginning of months, options do have kind of a replica effect, and there can be some profit taking right after they expire. That is the scenario number 2 that we also talked about yesterday. When it comes to next week, we have the unemployment rate coming in on Friday. There's an expectation of 4.1%, basically to maintain it, but if it was to increase, particularly if it's a large number relative to 4.1, it could spell concerns in the Fed, and the typical reaction is to see this as something broke, and according to historical reactions to that, they tend to ignite the quantitative easing, depending on how dramatic is the situation. If it was just as expected, that could be seen as negative because the current plan is to have very little reductions of the interest rates, and therefore that really doesn't help the prices of assets. Alright, let's go very quickly into the 4-hour. The beginning of the video is gonna be focused on the short-term price action, including all the data-driven information that we could use to define our own bias. On the 4-hour, by end of January, we had this breakout. We broke down on 25th of January. We rallied into resistance, and at that point, I recorded my video talking about 2 potential scenarios. One, low likely, which is to continue rallying against resistance with the RSI to the upside, and a highest likely scenario, which is to go to RSI 40. As you can see in here, that play out by the dollar. On Friday at 9 p.m., we went straight to RSI 40. Since then, we've been holding here forming some sort of double bottom. It is too early really to say that this is gonna stop here. 4-hour can have a lot of noise, but what I'm monitoring at the moment is if we pinch that RSI 4-hour of 40 and we head back down into the PNR level of 28, which is located at around 97K. So far, 4-hour is holding support. It's not the best support, it's kind of the last support before we re-enter the previous range, and then we have to call all this breakout a failed breakout, a fake out, which is very disappointing because we left all this liquidity right there and we were just 1K away from it. On the daily, we have a very similar picture. We have this yellow line in there that we've been talking about in the week. We test that as support support on the 28th. We already tested and we rally back into the median. You can see in here in the price action that that is still relevant. At the moment, that is RSI 51 on the daily and is similarly to the 4-hour kind of the line that is still holding us with some hope to rally into 63 RSI. That is the next level of resistance, and in the price is located at 108.7. If we were to lose the support of 101.6, that is a moving target. Every single day is going to be somewhere else. We need to start talking about the point of control. That is the area with more volume in all this range, which is at around 96.9. Okay, again 97, and a little bit more aggressive target is 92.3, which is at the bottom of the range on the daily. Let's move on to weekly time frame. Here is where we are going to have a little bit more of focus on longer term investors. Still applies to traders, but if you are long-term investor, pay attention to this part. At the end of the video, we're going to go into the data-driven information for trading, including the order book, liquidation levels, and all of that. That's going to again apply to the short term, just to clarify. On the weekly basis, what matters is these two tops, 108 and 109.5. Why? Because people, particularly the shorts, are hoping for a double top formation with a neck at around 93.5. And all they need now to get full conviction is to get to this neck and break below 93.8 with a target of 80k. We are at the moment in the bullish area of the range at 102.4. We were hoping to close above 104.4 because that will give us the highest close on a weekly candle in the whole history of Bitcoin. And although it's not as bullish as putting a new all-time high, candle closes on a weekly and monthly basis matter a lot. Unfortunately, we haven't done that, so we are in the area of the work in progress still. We are in the area of there is still some hope. As soon as we break below 98.2 and we close on a weekly basis that low, that is where we start talking about those shorts becoming really cocky, pushing it lower to the neck and then trying to aim as low as possible. I'm not sure whether they can really get into 80.5 if that happened, but they could sweep again the lows. Those lows are at 89. I left an order $50 away that I couldn't fill around there. Continuing with the weekly, you can see that we are pinching this yellow line there that represents an RSI of 69. That line there is the boss of the whole bull market on a weekly basis. We've been 3 weeks doing that, and this is creating a case for this move up to just be a dead cat bounce. And on a dead cat bounce, you put a high, then a lower high, and then you continue lower. I'm not saying that's the target, but that is the definition of a dead cat bounce. Why that RSI is the boss? Well, because, the whole bull market, it's been support, resistance. It threw us from 69k to 49k here. We reclaim it and it remains valid because recently on 30th of December, we tested and it pushed us to create a lower low. The pivots, now we have some sort of channel in there and we are being held by that resistance. So that yellow line there in the price is the same as this yellow line in here by using reverse RSI. Stochastic RSI on the weekly basis hasn't yet produced the bull cross. We close once again with the orange above the blue, so no good news from that. Let's move on to the monthly time frame. This is the CPR indicator. It consists of 9 lines that are drawn every month. They are drawn in the beginning of the month. Now we are on 1st of February, so we have the new lines there, the green, the white, and the red. In the month of January, we touch the first resistance, which is this green line there, and the model says that after touching the green line in a month, the month after, we should do the same. So here we did it in December, we did it again in January, and if we did it again in February, that will take us to 112k, give or take. At the moment, the pivots are very narrow between 99 and 101.5, and the full range of the month is 60k. So we got a very wild range for the price to explore in any direction. The CPR model says that any of these levels are achievable, and the pivots are meant to be strong support. So if we bounce now from that support somewhere inside the pivots up until 99k, we could say, we can bounce off and then go into 112 and fulfill what the model says is more likely. If we we lose the pivots and we touch the first support at 91.2, then everything flips on the monthly and we start talking about the next month to repeat that again. One of the reasons yesterday we were talking about the CME gap is because it was located at 102, and I was thinking that eventually we could close it. Now, with the tariffs announced right before market close on Friday, that spooked the market, and it was all the excuse that the market needed to go into the CME gap. And people were saying, is it gonna go beyond that point? Where, think about this, when the Chicago Exchange was closed, there were orders in here that couldn't be filled, and that acts as a magnet. Since on Friday, CME was still open and there was an excuse to go there, they managed to fill them, and that acted so far as support. It doesn't really guarantee anything, but you can tell that it's obvious that the CME gap, it is acting in here. Notice that this 102 is the premium price that people pay on CME. On Binance is 400 less, and sometimes it's even 1,000 less. On the monthly candle, once again, we created an engulfing green candle around the shooting star that everybody was freaking out in December, and here we are at the top. Unfortunately, January also has a week to the upside. I was wishing that we close above the previous all-time high to completely invalidate the shooting star. We could say that partially we have invalidated, but not 100%. Let's continue with the monthly. This is still content for long-term holders. Remember that I did a calculation of how long we remain on an RSI monthly above 70 cycle by cycle. That gives us 400, 300, 200 and 100, and we have now completed the 3 months that linear regression says that we can be above 70. After that we should be going below, but there is a caveat I want to share with you. I noticed a few days ago, which is when I count this 400, 300, I count the main chunk and I discard this early fake out that there is in February 2017. We went below 70 and I start counting from that moment. And if we were to do the same in here, because if you focus on the data window on the right hand side, we went below it. We were at 69.89, so no above 70 during December. So that means that if we repeat the way of counting of 2017, we should say that January is the first month, February is the second, and March is the third. And that could help potentially to also fulfill the narrative of the RSI going into this top, which we haven't done, and potentially please both at the same time. If we go to this level, that is 79, and 79 at the moment in the price is 117k. So that's why I've been talking about those targets. Remember that the top of the RSI is just the top of the acceleration of the price, is not the actual top of the dollar price. Okay, you can have dollar price to continue to rally while the RSI starts coming back down. That is called a bearish divergence, and you know that they are all over the place. Let's go now with the stochastic on the monthly. You can see that we have a dead cat bounce in here on the stochastic RSI monthly, but this one has the caveat that it ended up closing above 80. Okay, all the different dead cat bounces, including this one and this one in previous cycles, produce higher prices. For example, in 2013 we have another rally of 1,800 thanks to just this dead cat bounce, and in here in 2021 we have a second rally with a new all-time high. Even though it looks so insignificant, it still put a new all-time high. In here it is giving us a new all-time high because the first stop was at around 74, the second is at 109. But now what we care the most, guys, is if we confirm in February a bearish cross on the monthly, or if we keep the mouth open until March or later, because once we reach this area, after having been in the middle of the range, once we come back looking at past performance, we have never ever gone back up to 80. So dead cat bounce, bearish cross, end of bull market. Dead cat bounce, bearish cross, end of bull market. So let's keep attention to this. Let's be open for a different outcome, but with an eye on the risk that this represents for long-term holders. And I'm not telling you panic sell or anything. I'm just saying, let's see how February behaves. Let's continue now with short-term information to try to address now that support on the 4-hour and the daily, and that potential to go lower, not just going lower and breaking down some of the patterns that I talk about, but also if we break down, is it gonna be a bear trap and just come back up and take all the short shorts? Well, we need to look at data for that. Data point that I want to share now is the funding rates. Being in negative at the moment typically is connected with local bottoms. So keep that in mind. You cannot trade this by itself, but if we start seeing confluence towards upside, we might be able to do. I'm already in a position, by the way. I am long and I'm not looking to add at these levels, but it still helps me to decide whether to continue my position, reduce it, or just close it. You can see that retail is pretty much gone from the market. I disagree. Some channels are saying that they are here and they are not evident because there's too much dilution of millions of different tokens. I agree with that point, but I still think that the fact that there is no liquidity in the market, in global markets for retail, this has been so far the cycle of institutions where they enjoy this thing and retail just sits aside, watches, and just a few dudes that really love crypto are using it. And to me, that is bullish. I mean, retail being quiet in here, having been so euphoric in December, called for a local top, but this could call for a local bottom, seeing them gone so extreme, similar to when they left mid 2021 as well, where we have then another all-time high. Big Well Explorer is saying that there is a good ratio of deposits versus withdrawals. Many whales are just withdrawing from exchanges and sending it to cold storage. I have to say there is not a lot of activity. Volume is not huge, but at the very least we can confirm that they are not at the moment distributing big as they were doing in the middle of the megaphone pattern that took us 8 months to get out of that after they accumulated again in this area. The short-term holder realized price is for the first time above 90k. That means that that is the average entry price of the people that are lettuce hands. So it can act as a magnet if there was a market sell-off. So let's keep that number there in mind. Total cumulative flow from the ETFs this week put a new all-time high. You can see it in there. It's been a decent week. There was some outflows there, but overall ended up closing in the positive. We went into the extreme grid just for one day, and many of you are following my ritual, which is every time that there is an extreme grid day, I prepare myself the strongest coffee I can in the kitchen. I go in front of a mirror and I slap myself 3 times to make sure that it's very clear that during extreme grid you look for exits and not for entries. If every time that you see extreme grid you're trying to buy, enter longs, you are probably now in a very bad place. And this week the Federal Reserve did something that has me on my toes at the moment. We had a double bottom formation on the Federal Reserve balance sheet, which is calling for a very early sign, low quality, that we could see a reversal from here into quantitative easing. That's because they are increasing their balance sheet. But in the last week, we had a move down in there, reaching 3.2 trillion from 3.3. So that is not as significant to put a new low. So this could still be a channel to the upside. You can see that there are swings like this. It is during these channels to the upside in the balance sheet where all assets follow what the Fed does and they continue to invest. So if next week we put a new low in here, that is not gonna be a good February. And if we put a higher high, then we're gonna get very good news, following more or less what we saw in here and in all the bull rallies. Whenever the Fed is adding to the balance sheet, everything follows through. Liquidity. So we got a scary pattern in here on the 15 minutes. It can also be seen on the 1 hour. It's like a head and shoulders with a neck at 101.5. That is the pattern that at the moment I'm monitoring, both for confirming it or for discarding it. And looking at the liquidity in the short term that you can see on the screen in here, most of the liquidity is on the top. The target of this pattern, if we measure it from top to bottom, it's pointing directly into this cluster of liquidity at 96k, okay? And that confirms as well a potential A, B, and C correction completing. But here's the caveat. If we are going for that liquidity, and if it's so little relative to this one that we were 1k away, my opinion is that we sold off just because of the fears of the general market. There was, in my opinion, just a delay in the original plan due to those news. So if that's the case, and I'm right on this, which I could be totally wrong, price could go to the 96k. I think that is low likely. It is possible, absolutely. So should we discard it and just put our stop stop loss and get our account liquidated there because it's low likely. No, precisely the opposite. You take into consideration that price might go there and complete the C wave, and you don't have your risk there, but you start being sneaky. We look into data to see what else supports a fake move. For example, the price goes this deep and then suddenly does a V recovery and it shoots back up in the middle of next week. Is that possible? Oh yeah, sure. There's a lot of liquidity in here, right? So as soon as someone says, I think Trump is going to delay the tariffs, or something really implies from the unemployment rate on Friday that the Fed must do quantitative easing. And at that point, you get a V recovery and everybody forgets about these peanuts and they are immediately getting greedy with taking the shorts that start from 107, and on the longer term, you get them into 126K. Yes, there is new liquidity at 85, but to get to 85, we really need the general markets to crash. Or at the very least, we need to be in summer, which is where we typically have that flash in the market. February, can it happen? Well, look at the past performance. It's almost all the time green. We have a 31% in 2014. We have a minus 8.6 starting with COVID, and ignoring those two exceptions, we get either flat or big returns in February with an average of 15% and a median of 12. Let's scan for more data points. We got longs liquidated yesterday with 300 million. That is a data point by itself. We tend to flip between longs and shorts every now and then, and we've been punishing the longs now for a while. Bidding liquidity, you can see, is increasing to 0.1 at the moment. It is not as substantial as the 0.2 that kind of saved the day at 98K, but it is something. Bulls are wanting to buy this. This is one data point showing bulls interested in that level of 100K, defending it. Second data point is the global longs accounts on Binance are at highs of 62, very similar to 65 where we found a bottom at 98. Contrarian to being at the bottom of 43 is where kind of the longs throw the towel and they let the price roll over and crash. So that is another data point. Unfortunately, the delta of liquidations in the short term on high block capital is so shallow. It's just 43K, so we cannot really use it for anything today. Wells are not pointing in any direction. Welcome to the price action of the weekend. On weekends, that's what you see. They don't go anywhere. They don't show any direction. But I'm sure that on Monday that is going to change, particularly with market open. On the order book, 91K has an interest in buying and 78K. Those orders are still there and they are substantial. On the delta, we have a development in here. The longs broke out to the upside. Unfortunately, that breakout is not with a full reset at the bottom of the area like we did 20th of December. That was a decent area to look for longs. I still think that this area was good for longs, but it's not the golden area, and it's important to state that. In the past, from 19th of December, longs crash, longs liquidated, and they continue to get liquidated. We haven't had shorts being liquidated big like we did at 108K. Not even in this area there were too many shorts liquidated, so eventually we need to get those shorts to have some fun as well. Liquidation levels now is very shallow in the past 30 days. In the downside, that is a good data point to say it's not as attractive, for example, as going into 106.5 or going into 109.5. So as soon as we get a narrative that discards those fears, we get in here a very good incentive for market maker to not continue wasting their time with low liquidity on the lower end and go for the higher one. Looking at fair value gaps, we have just a very chunky here starting from 102.7 into 104.2. That is caused by that big volatility drop in the price in just a single candle of 4 hours. After that, we have the 96. That coincides with the area of lower liquidity that we have on the downside, and in case we did the C wave that we talk about, A, B, and C, right? At this area in here is where I start getting interested potentially in adding more liquidity. Remember that recently I add at 98, so I don't want to add too close, but if you're sitting on your hands next week and we went this low, I'm sure that we're gonna find some decent swings. I think I mentioned it in the beginning, but the negative funding rates are also great alpha to look for potential swings up, and there is a decent chance that over the weekend or by Monday we take this fair value gap before going lower. let's keep an eye for that. Guys, if you want to trade Bitcoin, altcoins, I've got the best selection of deals to open new accounts on exchanges. Bybit and OKX are my preferred exchanges when it comes to available tokens, levels of leverage, and overall execution is excellent. They offer very big bonuses and discounts on fees, but if you want to stay away from KYC, no need to do it, no need a VPN and open as many accounts as you want. There's also very big bonuses on 2bit and CoinCatch. Those are two exchanges that work really well and that don't require KYC. Thanks so much for watching the video, and I'll see you on the next one. Bye bye.